Welcome, dear traders. It's too early to talk about cuts. Inflation is too high. ECB policymaker Joachim Nagel said yesterday. He added that the mistake of lowering interest rates too early should be avoided, and similar comments came from Fed Reserve speakers last week. Rising geopolitical tensions in the several troubled areas continue to fuel global economic uncertainty. On Monday, more oil tankers left the southern Red Sea, detouring the dangerous area. The longer route will delay deliveries, increase shipping costs, and set the stage for future price hikes. Therefore, traders should reconsider their views on an early Fed rate cut. However, according to the FedWatch Tool, most traders still price in a March rate cut. Yesterday, this indicator stood at 70%, and today it was lower at 66%. Furthermore, this move is considered to be too aggressive by the majority of analysts, considering that their fourth quarter earnings season is starting in the United States. Market volatility is likely to increase. In addition, global political sentiment is increasing the demand for safe haven assets, including the US currency. However, the presidential election campaign that has started in the United States may hinder stable demand for the US dollar, especially after Donald Trump's victory in the Republican caucus in the state of Iowa. Against the backdrop, the US dollar index jumped to the area of 103 and hit a new weekly high. At the beginning of Tuesday, the greenback continued to maintain bullish momentum in the range of 102.70 and 103.00 in the Asian session. Against its six counterparts, the US currency has already added almost 0.5% since the beginning of the week. If the bullish trend continues, the greenback is likely to reach the technical resistance area of 103.10 and 103.50, and the first support is located at 101.90. The reversal of the US dollar index may follow after Fed policymaker Christopher Waller's speech. And notably, Waller's dovish comments in November triggered a stock market rally at the end of 2023. So far, the US dollar continues to dominate the market, strengthening across the board today. In addition, investors favored the US currency the most against the antipodean currencies. The Japanese currency also weakened against the US currency. However, after the strong growth of the dollar-yen pair at the beginning of Tuesday, its trading range of 145.50 and 146.30 began to look more restrained. Today, the country's largest business lobby, Keidanren Japan Business Federation, advocated an increase in wages for employees. Many leading companies, the so-called blue chips, are expected to take such a step. And this year's wage negotiations are not only about improving the living standards of Japanese households, but also about the prospects of the Bank of Japan easing its monetary policy. As a result, the dollar-yen pair started a consolidation early Tuesday, hovering along the 146.10 mark. However, it's still maintaining bullish momentum and may test the psychological resistance level of 146.50. The next support is located in the area of 146.50 and 145.00. The economic situation in China continues to wane on the sentiment in the Asia-Pacific region. The top management of the largest private property developer, Country Garden, believes that the property market will remain weak until 2024. Meanwhile, the developer may face even more serious problems. Yesterday, China's central bank kept the one-year medium-term lending rate unchanged at 2.5%. At the World Economic Forum in Davos, International Monetary Fund Managing Director KRISTALINA warned that China needed structural reforms. As investors await China's GDP data, the country has taken another major step to revive its troubled real estate sector. One of China's largest lenders, Ping'an Bank, has reportedly added 41 companies to its list of real estate developers eligible for financial support, and China's real estate sector has been struggling with a liquidity crisis since mid-2011, with the major developers defaulting or delaying debt payments as they try to sell apartments and raise funds, holding back growth in the world's second-largest economy. Market troubles in Australia's major trading partner, risk-off sentiment in the equity markets, and stabilizing oil prices sent the Australian dollar down within the 0.6600 and 0.6670 range today. The Aussie continued its losing streak that began on January 11. On January 16, the Aussie dollar pair plunged to its monthly low below 0.6620. In a case of further pressure from a stronger US dollar, the pair may reach the support area over 0.6610 and 0.6500. However, the Aussie is unlikely to see bullish momentum in the near future. Today's reports showed that consumer confidence in Australia turned negative, posting minus 1.3%. Notably, December's figure was 2.7%, and this indicator reinforces expectations for a softer decision by the Reserve Bank of Australia at its February meeting. The New Zealand dollar has fallen to the support area of 0.6150 from the resistance level of 0.6200 yesterday. The Kiwi is fallen for the second session in a row, hitting the monthly lows near 0.6160. In addition to external factors, the New Zealand dollar is also under pressure from domestic sentiment. Reports showed that business confidence in New Zealand has improved significantly. In the fourth quarter, only 2% of firms had expectations of a deterioration in business conditions. These companies and compares to a whopping 52% in the third quarter. As a result, there has been an increase in expectations that the country's central bank will likely issue monetary policy before the end of the year. And notably, such prospects may push the New Zealand currency down. And that's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.